Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Fortior Technology, Shenzhen Co. Limited, Annual Report. Fortior Technology, Shenzhen Co. Limited, offers a diverse range of products and services to cater to various industries. At the core of their offerings are driver and control IC chips for motor systems, which are supplied to markets across Asia, North America, and Europe. Their product lineup includes three-phase ASIC series, single-phase ASIC series, driver IC series, MOSFET series, MCU series, and IPM series. These chips are utilized in a wide array of applications, such as industrial equipment, motion control systems, automobiles, power tools, medical devices, household appliances, consumer electronics, and more. The company's expertise extends to various fields, including AI and robotics, IT and communications, sports and travel, and power and garden tools. With its headquarters in Shenzhen, China, Fortior Technology has established itself as a prominent player in the industry since its founding in 2010. Fortior Technology, Shenzhen Co. Limited, market capitalization of $20 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Fortior Technology, Shenzhen Co. Limited, holds a significant advantage in their industry. Fortior Technology, Shenzhen Co. Limited, trades at a higher price-to-earnings ratio of 41 times and a higher price-to-book ratio of 2.01 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 4% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the given summary. On the revenue growth side, several key factors contribute to the increase in revenue. Firstly, the company has seen a significant rise in sales from mainland China and other countries/regions, with a notable 28.9% increase in total revenue. This is largely driven by the increasing demand for energy-saving and emission reduction solutions, as well as the rapid adoption of BLDC motors globally. The company's MCU sales have also seen a substantial increase of 25.6%, while its highly reliable products with efficient upgrades and broad application versatility have contributed to its growth. Additionally, the company's joint ventures and partnerships, launch of new products, continuous investment in R&D, and strategic deployment in emerging applications have all played a significant role. On the other hand, the primary drivers of revenue decline can be attributed to a decrease in proportion of revenue from white goods, which has dropped from 53.5% to 18.3%. This shift in market demand is likely due to changes in consumer behavior and preferences towards more energy-efficient and environmentally friendly products. Net income experienced a significant increase of 26.8% between 2024 and the reporting period, rising from RMB 316 million to RMB 400.7 million. This substantial growth indicates a notable improvement in the company's financial performance. However, despite this increase in net income, profit margins actually decreased slightly during the same period. The profit margin dropped from 52.6% in 2024 to 51.8% in the reporting period. This decrease suggests that while the company is generating more revenue, it may be doing so at a lower rate of profitability compared to previous years. The company's financial health has shown a positive trend over the past year. A significant decrease in debt level is evident, with a reduction of RMB 231,000 846 from 2024 to 2025. This decline brings down the overall debt level from RMB 794,344 to RMB 562,498. Furthermore, the debt-to-asset ratio has also decreased, indicating that the company's assets have increased in value relative to its liabilities. The ratio dropped from 3.6% to 2.9%, suggesting a more stable financial position for the company. However, there is no information available regarding interest expenses, which could provide further insight into the company's financial performance. The company's performance can be analyzed through its various segments. On the positive side, smart small household appliances and electric tools in sports and leisure have been strong contributors to the company's sales. In fact, the latter segment has accounted for a significant 53.5% of total sales revenue. Additionally, industrial applications and the automotive sector have also performed well, with the latter generating 11.8% of operating revenue from automotive-grade chips. However, not all segments have fared equally well. The white goods segment has been a notable underperformer, accounting for only 18.3% of total sales revenue despite being a significant portion of the company's overall business. This decline is particularly concerning given its previous performance levels. Overall, these results suggest that the company's focus should be on building on its strengths in smart small household appliances and electric tools while addressing the challenges facing its white goods segment. Management's outlook on the company is one of steady progress and expansion. Despite the recent amendments to IFRS standards having no significant impact on the financial statements, the company remains committed to its strategy of becoming a leading global supplier of motor control chips and control systems. This goal will be achieved through independent innovation and technological R&D, with a focus on emerging applications in industrial, automotive, and robot sectors. The company plans to expand its product offerings, technologies, markets, and customer base globally by leveraging its technological advantages and pursuing strategic investments and acquisitions overseas. Management has also emphasized the importance of maintaining a sound financial position, investing selectively, and maximizing returns on idle funds while maintaining high liquidity and low risk. In terms of specific goals, the company aims to utilize net proceeds from the listing for strengthening R&D and innovation capabilities, enriching its product portfolio, expanding downstream applications, and achieving long-term growth strategies through strategic investments and or acquisitions. Overall, management's strategy is centered around driving growth, innovation, and expansion while maintaining a strong financial position. There is no notable activity in terms of acquisitions or divestitures. The company has not made any significant purchases or sales of assets, businesses, or subsidiaries that would be considered major transactions. This suggests a stable and conservative approach to business operations, with a focus on maintaining existing resources and capabilities rather than expanding through external means. The company has a history of paying dividends to its shareholders. According to the provided summary, the company declared and proposed dividends totaling RMB 71,893,000 and RMB 89,789,000 respectively. Furthermore, it was confirmed that these dividends were paid out in 2025, with a total amount of RMB 71.9 million being distributed among shareholders. Additionally, the final dividend per share was RMB 0.78. This indicates a consistent practice of returning profits to investors through dividend payments. There are concerns about inventory buildup in the company's supply chain. The data suggests that there has been a significant increase in both raw materials and finished goods, with a rise of 42.7% and 68.1%, respectively. This surplus is further exacerbated by the substantial increase in inventory impairment losses, which have risen by 31.3%. Additionally, the company has made provisions against obsolete and slow-moving inventories, indicating that it anticipates difficulties in selling these items. These indicators collectively point to a buildup of inventory, which could potentially disrupt the supply chain if not managed effectively. That concludes the financial summary for Fortior Technology, Shenzhen Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.